Hey, good afternoon, and welcome to another ACUMA webinar. This one's being brought to you by MCT, our friends over at MCT. My name is Peter Benjamin. I'm the president of ACUMA, and I'm really excited for today's webinar. Our friends over at MCT are going to really dive into a hot topic that's facing a lot of credit unions in this current market. Again, I couldn't be more thrilled to thank Andrew and Phil for their knowledge and their time. And really, when we sat down planning out this webinar, everything that they were saying just was hitting home, and everything that I was hearing at various ACUMA events. I think all of our members will get a lot out of this today's webinar. Truly do believe that. Before I pass the baton over to Phil and Andrew, just one quick update from ACUMA. Earlier this month, we opened up registration to our annual conference being held at the Gaylord National Harbor just outside Washington, D.C. It's being held from October 1st to October 4th. This is going to be an amazing event. I promise you're not going to want to miss it. So if you can, come on out to Washington, D.C., October 1st through 4th. It's going to be the best and the biggest ACUMA event that we've ever had. So we hope to see you there. For more information, go to acuma.org and look up all of our events. Other than that, gentlemen, I'm just going to take a step back and pass this one on to you. Thank you very much for your time. Really appreciate your support in bringing this to our members.
Well, thanks a lot, Peter. And yeah, no, we really appreciate the opportunity for ACUMA to present here. And we noticed went over the registration list. We noticed we've got a dozen or so current hedge customers on the line. So as you guys know, we do a lot of customer webinars, kind of real-time webinars. So some of this stuff will be a little bit of review. But hopefully you'll be able to get some out of it as we cater this a little bit more directly to credit unions. But no, we'll just jump right into it. My name is Phil Rosori, Chief Operating Officer of MCT, and we've got Andrew Rhodes here, who is the director of our trade desk. And so I'll give an overview of kind of where what we're seeing in the current market versus and kind of put that against what we saw a year ago, and how things have although it's no picnic out there, how things have definitely smoothed out from where we were a year ago. It will also go in, then we'll move from kind of high level more to get into the nuts and bolts of some trading best practices. And of course, Andrew is no one better than Andrew to be able to take us through some of those recommendations. We'll talk a little bit about some of the technology innovations that are coming to market from the execution side. We're seeing on the execution side. Look, that specifically to credit unions, depositories in general, we've definitely seen a swing, I think, in the last year, where organizations in general that were the vast majority of their production historically had been servicing retained. Just because of the, in light of recent events and, liquidity being king, we've definitely seen a lot more servicing execution, servicing sale execution, and on the flow. And so that's going to take two forms. That's going to take your aggregator servicing release execution, and then also on your flow co-issue execution. And that's where we're real excited about a kind of a innovation, some innovation that we're working on with the partner buyers there. So and then we'll get into some Q&A. We'll definitely have some time left over for that. I think Andrew and I are definitely not real formal in our presentation, so definitely put your questions in, and we will get to them right in the middle of the webinar. I'm real good at interrupting Andrew in his presentation, so that'll work fine. And then we've got some poll questions as well along the way. But like I said, a lot to cover, so we'll just hop right into it. Dave, if we can go to the next slide. So we did a webinar, basically almost an identical webinar a year ago, exactly. And so it's kind of interesting to take a look at where we were, and then in the next slide we'll show where we are now. And so if you look at where we were, there was a lot of bad news, right? We had this obviously declining volume because of the steeply rising rate environment, but that was causing a lot of issues with regards to security pricing, right? We were continuing to transcend coupons, starting with at the beginning of 2022, when the good old days of whatever that was, a 2.5 or a 3% coupon, and then it was 3.5, 4, 4.5, 5, and literally we were getting all the way up into the third quarter of last year, where we were hitting the rates that we are now in the in the high 6s and into the 7s. And that was creating a deteriorating MBS conditions, because in addition to trading all of these new coupons where the liquidity wasn't great, you were also running into issues where the market was adjusting that the biggest buyer of mortgage-backed securities in the last 14 years, which of course was the Fed, was basically outlining to the market that they were not only removing their additional buying, that they were going to begin to engage in a runoff starting at the end of the third quarter, middle of September of last year. So that was creating even more bid offer spread issues on the TBA side. So and when you had those execution issues, you also had that par compression, that price compression, which was causing massive issues with regards to trying to get origination pricing above par, being able to get par rates out, which so we had again, not a lot of things going against us. So if we move to the next slide, and look a year later, we are although it's it's no picnic out there, things have stabilized year over year. Not that volumes have come back, it's really just that we're in last year, middle of 2022, we're comparing year over year to middle of 2021. So obviously there's been a huge drop, 21 to 22. Now we're a little bit, we've kind of stabilized a little bit more year over year, and more importantly, on the on the security side, no one's going to argue that it's real easy to have strong rebate pricing out there right now. With that said, we're in a much better position with tradability on coupons like the 6 coupon, which gets us the more efficient pricing into the high 6s. So we're excuse me, in note rates. So we're definitely looking better. Obviously bid offer spreads are still problematic as you get into higher coupons, and it remains to be seen where we go from here, right? I think we all agree, everybody on the line here agrees, that if you continue to print non-farm payroll numbers that blow out expectations, blow out the consensus every month, it really doesn't matter where kind of what the Fed says or what the market thinks, but you're going to have a hard time making the case for lower rates, right? So it all depends what happens with with the job market, obviously, and inflation as well, but job market being a driver of long-term inflation, The reason I say that is that, you know, if we can stay kind of in this range, you know, we expect you're going to continue to see, you know, more liquidity in the, you know, in the coupons, even the more fringier coupons. You're gonna see that the 6.5, 7 coupons, you'll see those come more in line, which again will result in more competitive, you know, all things being relative, it'll be more competitive execution at the higher note rates. Look, AOTs, we'll talk about that. I know that, again, historically for credit unions, when we talk about an AOT, that's an assignment of trade. By definition, you are selling your loans. In that situation, you're selling your loans to an aggregator who's buying that production, buying the servicing, and then you're assigning that trade, that hedge position, that TBA associated with that hedge. You're assigning that to the loan buyer, and there's really some benefits that you get for reducing your bid offer spread. Now that and Andrew can go into a little bit more of the mechanics of an AOT. And like I had said earlier, historically, this has not been something that's used by a lot of credit unions. But now that we're seeing quite a bit more servicing released execution from credit unions, depositories in general, AOTs are definitely more of a relevant execution method. And so again, and just especially on the coupons that have higher bid offer spreads, we definitely see obviously mathematical savings there for using AOTs, and then on TBA bidding, competitive bidding is essential because of the fact that in an inefficient market, it's not that any one dealer might be putting a huge margin and charging you a lot for that trade. It's just that dealer may be getting a different indication, or just if they're a position taker, they might have a different value on that given security than another dealer. Historically, that difference might have been half of a 30-second, 1.5 basis points. Now you're seeing regularly, swings of 2 to 3 30 seconds. So that's 6-9 basis points. On the government side or higher coupon side, you could see even more. So obviously, it's essential to get multiple bids, for those TBAs. So Andrew's going to go in more depth here, but I think as kind of a good transition topic, I think for the next slide here, we have a audience poll, our first poll question. And maybe I should have asked this question. I probably should have put this slide earlier, because we dove right into some specifics specific to hedging. But basically, are you currently hedging or delivering loans on a mandatory basis? And this will be, we're interested. It looks like we got, looks like the answers are coming in here. And Dave, I'm not sure. Okay, so it looks like we got, okay, so yeah, so this is so 2/3 of you guys are not not hedging, delivering loans on a mandatory basis to, and I know a lot of credit unions from a risk or a volume standpoint do deliver on best efforts. So Andrew, with that kind of as the backdrop here, understanding that I jumped into a lot of specifics on bid offer spreads and assignment of trade and par compression on high coupons. That probably didn't make sense to 64% of the audience. So maybe, if you can talk a little bit about, maybe you can first talk as we, talk about difference between mandatory best efforts, and then also maybe some specifics on, some basics on how we manage the risk and how an assignment of trade factors in there. Oh, Andrew, I think I got you on mute.
There we go. Yeah, thanks for that, Phil. So it's given the response, it definitely makes sense that a lot of the risk is being passed back to the investors. But one of the biggest reasons that people kind of step into the hedging world and into the mandatory space is so they can kind of take that next step in becoming, I guess, a more efficient and kind of have a better execution from a delivery standpoint to their investor set. So the difference between best efforts and mandatory is essentially on a best effort basis, you are taking the loan, originating it, but you're handing it off to the investor to manage the interest rate exposure position during the loan manufacturing process. So in a mandatory environment, what you're doing is you're originating that loan, you're locking in that interest rate risk with that borrower, and then you're managing the interest rate exposure position during the loan manufacturing process. And at the end of the loan manufacturing process, you're taking that funded closed loan and you're selling that off to the investor of your choice based off of your investor set, based off of whoever has the best price that day. So if you're only approved with, let's just say you're only approved with the agencies and you're only going to either Fannie or Freddie, then that kind of, will be dictated earlier in the process where you could kind of manage it a little bit differently. But let's just say you're delivering to an aggregator execution at the end of the loan manufacturing process. That's where, you're able to see this kind of mandatory pickup. And that's exactly what this graph right here is showing. So the red line there is just what we do is we track loan sale data for all of our clients, and we're tracking the best effort price the day that the loan was committed, and then comparing that to the best mandatory price the day that the loan was committed. And you can see the red line here is just a 5-day moving average, and this is going back to the beginning of the year. So we've had that spread range anywhere from 20 to call it 46 basis points over the year. So that's the added execution potential by taking on that interest rate exposure position instead of offlaying it to the investor immediately for that best effort delivery. So from a best practices standpoint in terms of managing that interest rate exposure position, that's where MCT kind of prides itself in kind of working with the lenders and making sure that they understand everything that goes on in the model and in the hedge and with their position. So the best way to manage that interest rate position for this lock that you have is to short a to be announced mortgage-backed security. And the reason for that is because at the end of the day, that originated loan could potentially go into that TBA forward position. So Phil was talking about AOTs, which is assignment of trade. So let's just say in this example, we have a $500,000 loan and a $500,000 trade. Real world doesn't work that way, but let's just go with it. There's going to be, during the loan manufacturing process, you're going to figure out who the best investor for that loan is going to be. And then let's just say they have an AOT program. You could essentially assign that loan into that, or assign that trade to the investor along with that loan. And essentially by doing that, it's kind of like taking a forward position with an investor, because
essentially the economics of that trade. So whatever the interest rate or whatever the happens to the market over that period of time during the loan manufacturing process is going to be accounted for in that short position on the TBA side. So you're going to have some exposure, positive or negative, based off of what the market does. And when you're delivering that loan to the investor, you're also assigning them that trade. And the way that the investor takes that assignment or trade position in is that they're resetting their strike position for that loan on the mandatory side to be based off of what the original TBA price was on for your hedge position for that loan. So essentially the economics of it, as Phil was mentioning earlier, work out to be that you're saving the bid-ask spread, and given the current environment that we're in, with the Fed not providing the liquidity that it has been for the past 14 years, we're seeing that wide to be anywhere from 2 to 4 ticks, 2 to 5 ticks, which could equate to 6 to 15 basis points in additional pickup. So I think just from a high level, kind of managing the risk is something that MCT takes pride in. I've been working with MCT going back to 2005, and we've been bringing on clients of all shapes and sizes, helping them manage their interest rate position in all different kinds of ways. One way that I know a lot of credit unions are comfortable with is managing their interest rate lock positions via forward commitments with the agencies. That is a good way to offset that interest rate exposure position, but you are also kind of handcuffing yourself in terms of execution when that loan comes to fund. If you have multiple outlets and if you are able to deliver to more investors, you're kind of you're not being able to maximize your profitability on that production by kind of using those forward positions. So another reason that we like to use TBAs as our primary hedge strategy for originating loans and hedging that production. So we could definitely help you guys maximize that profitability. As I said just a couple seconds ago, AOT pickups has been anywhere from I think 2 to 5 ticks. I think on average, I was looking at it the other day, it's close to 3.5 ticks. So that right there is close to call it 10 to 11 basis points, and that's just an AOT savings. That's not even talking about the hedge pickup or the mandatory pickup by taking on the interest rate exposure position yourselves instead of offlaying that to the investors. So I think the previous slide is anywhere from 20 to 46. It looks like the average is about 29 basis points year to date, and that's, like I said, that's not including that additional AOT savings that you're getting, because that is essentially reducing the dealer offer side that you're needing to do to get out of that short position for the TBA side. So I know the way, I guess, the way to look at to kind of take a step back, the way to look at a hedge position is, the loan that you guys are originating is essentially that long position, and that's why we're having to use a short position to offset that during the loan manufacturing process, and that's what counterbalances the profitability between your loan asset and your short derivative asset. And we'd be able to help any clients kind of walk through the accounting piece of the whole process, as well as kind of making sure you guys understand everything that's going on, which is important to do when you're kind of taking on more risk in this market. But another one of the benefits of kind of stepping into hedging is to kind of get a pickup in the operations as well. So when you're delivering on a best effort basis, you have one loan going to one investor, and that is essentially it. You're managing that process for that one loan with that one investor, and any changes that happen, you're going to have to go back and modify that. In the mandatory space, you're the one that's managing that process. So any changes that happen to the file, if you need to change the LTV from, call it 85 to 75, that is just a difference in pricing reflected on your, on your side that you're going to have to manage. But you don't have to go to the investor website. You don't have to go modify that, change that. So from an operational standpoint, it's a lot more efficient to be in a mandatory environment, because you don't have to have all those little touch points with all the different investors managing the whole origination cycle with them. So I think, we put the kind of typical requirements together. I think it's a little on the conservative side. We do have clients who are originating less volume and still hedging and still, making a profit. But I think, 10 million a month in mortgage origination volume is a safe kind of barrier to entry. Like I said, we have clients doing less than that, and they're still finding value in the hedging environment. I think 1.5 million net worth, I don't think that'd be a problem for any credit union. So I don't think net worth would be an issue. And then the GSEs, I think a lot of you guys already have those approvals. And if not, you're probably working on getting them. Then this last data point here is just to have a centralized lock desk, and what that does is that just kind of helps with the whole operational flows. You'll be able to find a specific kind of specific parameters of a product. You'll be able to kind of be able to streamline the underwriting and delivery process to your set of investors, because you want to make sure that you're able to get that maximum execution on the back end side for all of your originations. And I think we'll be sending this deck out as well. So there's a couple hyperlinks in here that will come up, but we'll make sure to get this deck out to everybody that's on the line as well. And then I think that leads us into our next poll question. So based off the previous poll, I think we're probably going to see something similar here. Are you consistently getting 4 or more quotes on every TBA trade? Yeah, Phil, I wasn't sure if you had anything that you wanted to add to the whole best effort to mandatory kind of move, or just kind of taking on more of that interest rate position.
No, that was great. I think yeah, the poll, obviously this poll, and then I think the next one as well will probably have to it's probably higher than 14% of the of those that are actually hedging. So I think that's a little bit skewed, but no, Andrew, thank you for the for the overview there. And yeah, I think maybe on the next slide, just taking again, because the 2/3 of the audience is not hedging, we won't focus as much time, but it definitely, I think, going over how the differences occur, and how we see government versus conventional execution on the hedge differentials and execution on the hedge. I think that's definitely valuable to everybody.
Okay, cool. So I think as kind of Phil was alluding to, not really probably not really a lot of probably not going to hit home with a lot of people right now, but I think just looking at it and just understanding the spreads that we're seeing tells the story of how there are pockets in the industry where you're able to kind of get those add those additional efficiencies, and that all comes to bear in your bottom line, right? So getting that additional profitability, into your hands that you're able to pass down to your originators, pass down to the borrowers. I think at the end of the day, it's all about, being able to provide, being able to get that best execution to be able to provide, better pricing down to the originators and borrowers. But in this analysis here, what we're doing is we're taking a look at trades that are put out to multiple broker dealers and kind of databasing that on our side. And this is essentially what we're doing is taking the daily average of all the trades done with multiple dealers to calculate, to kind of pull these numbers together for this graph. So, at the beginning of the year is a little bit over a half tick when you're looking at the spread between the maximum price and the average price, which doesn't sound like much, but 1.5 basis points on your TBA production will add up over time. And the other numbers in here, I guess we have a spread to minimum, so that's just the highest price compared to the lowest price. So in this screenshot down below, you can see that there, back in on May 12th, we did a bid for 2 million jumbo 5s in July. At that point in time, that was close to par, so close to a par coupon, a lot of liquidity. And to specifically what Phil was touching on in regards to kind of the UM30 product or the conventional product compared to the government product or the G2SF here product is, there are some wider spreads between the different products, so they're able to kind of pick up some advantages. And you can see, so looking at all the bids on this execution, I calculated out the average to be close to 99.11 3/8. You can see that the best bid here is 99 16 3/8. So right there, that's a 5-tick pickup just for this one trade, for being a liquid coupon in the market. Coupon, that's a wide disparity. And then if you're looking at the the larger spread, down to 4.5 up to 16 3/8, I mean, that's close to a 12-tick differential. So that's why we recommend, whenever we're doing our trades or whenever we're talking to clients, to go ahead and make sure that they're validating the price that they're getting by calling multiple broker dealers or using a platform that has access to multiple broker dealers. I think, I think we could probably move on to the next slide unless you had something else you wanted to add to this, Phil.
No, that's great. And again, on the I think with regards to this poll, I think we'll probably get the same kind of ratios as the trade poll. But look, bottom line, we do expect we expect the trend to continue. As far as servicing, obviously, we only just with respect to servicing released execution. Obviously, we are only looking at things on the execution side. Obviously, from your perspective of continuing that customer relationship, we totally understand. Our job in capital market, your capital markets partner, your capital markets advisor, is really to just give you an execution analysis. And historically, I think that in general, as the asset definitely gets more valuable, obviously, as the market as rates rise. But what we've seen recently is just with the additional, those values have kind of capped out, and then as liquidity has become important for lenders of all all sizes and depositories and credit unions as well. Like I said at the outset, we've definitely seen a lot more groups, lenders begin to sell servicing release that did not before. And so to the extent you sell to aggregators, the future is in AOT. It is in assignment of trade, and that's simply because it's too efficient of a business. There's too little margin in the business to be able to give up some of these bid offer spreads that you're seeing, that Andrew was showing. So that savings, and I know on the next slide here, Andrew can kind of take us through what the savings are, have been by assigning your trades into your production versus just committing and pairing off.
Yeah, so this is kind of a similar graph that we pulled together just on the data on the AOT pickups that we're seeing. So as kind of Phil was mentioning, the benefits of the AOT is that you're reducing your essentially your cost on it by not having to pair out of the trade with the broker dealer, and you're assigning that over to the investor. So that's essentially that bid-ask spread savings that we're calculating in this graph, and that spread is widened out over the past year, just given the fact that the Fed's not in there providing the liquidity that they are. So we're seeing UM30 spreads. I think today on the 5.5 coupon, you got a two tick spread on the front month on the conventional side, and then on the government side, it's about 2+ on the conventional on the government side. So that right there is about six basis points of saving on everything that you're able to assign. All the trades that you're able to assign over to dealers is just more kind of more basis points that you're able to add to the bottom line, which is kind of what it's all about, just kind of improving that pickup. So one thing that we're continuing to push on the investor community is the hybrid AOT flexibility and functionality. I'm not sure if everyone on the line, I know it says about 43% are doing AOTs, and hopefully you guys are doing that via a hybrid AOT methodology. But kind of just take a step back, legacy AOTs, we're definitely used in the past. However, they're a lot more rigid in terms of what they were able to allow. You had to have at least within a 1 to 2% tolerance of the total loan amount that you're delivering to the investor in the trade. So meaning if you had a $1 million trade that you wanted to assign to an investor, you had to have within a 1 to 2% tolerance of $1 million in that same security and coupon. So it never really matched up. Unless you were doing a lot of volume, it was hard to actually make those AOTs work. With this new hybrid AOT model, or the bid tape AOT model, the investors are becoming a lot more flexible in what they're able to allow you to assign and deliver to them. So let's just say you had $1 million trade you wanted to assign. There are certain investors out there that will allow you to deliver $600,000 in loans to assign that $1 million trade. And the way that they kind of do that is they're converting the basis points, or they're converting the exposure on the trade into basis points based off the volume delivered. So they're able to kind of use kind of work with the math side of it and pull that exposure into basis points and convert it into that exposure into the loan production that they're going to be buying. So it really has become a lot more flexible. There are certain investors out in the market that will allow you to deliver loans that have note rates outside of the coupons that you want to assign them. So let's say you had a 7% or a 6% coupon, but all your production was in a 5 coupon. There are some investors that allow you that kind of flexibility to assign that outside of the loans that you're delivering a coupon, and that you're able to kind of use. So we're continuing to push that flexibility and functionality out to all the investors. Currently, we have 14 investors that are offering it. And it's a benefit, like Phil was saying, it really is a benefit for everybody, because these larger investors that are able to offer this AOT, they're actually able to securitize and take their securitizations and trade their securitizations on swap as well, which give them the added benefit of reducing that bid-ask spread. So just a way for them to become more efficient and get more production in the door, so they're able to maximize the profitability on their side as well. If we want to go into the next slide. So this is kind of just a high-level overview. So close to 7 billion in assignments so far this year. It's like I said, it's something that we're going to continue to push, and we need to find ways to make everybody more efficient, because in markets like these, you need to find basis points wherever you can. So we're trying to help push lenders to do AOTs and push investors to do AOTs, because at the end of the day, it just kind of saves everybody some basis points. Like we've been saying, the bid offer spread has been wide, and that's just because the Fed's not in the market anymore buying the market. So I think as we continue to see volatility, we'll continue to see these bid-ask spreads stay wider. And given what Powell just came out with the other day, we're essentially looking at potentially two more hikes this year. Definitely not cutting anytime soon. So I think that's just going to add more volatility to the markets until we find a plateau or where they feel comfortable leaving it. And that's the goal here, is to make everybody's lives easier. One of the things about the legacy AOT model is, you had to get the tri-party, fill it out, scan it, fax it to the broker dealer. We've kind of automated that whole process with the investors, and we're working on automating it with the dealers as well. So essentially, when you're in our system doing a best X, we'll show you the opportunities that you have to do assignments, and you could choose to do them or not. And if you do choose to do them, then all that tri-party paperwork, AOT paperwork, is going to be processed, and then you just have to send that out to, or that gets sent over to the investors, and then the investors will send that over to the broker dealers to essentially process the whole transaction. But it's all in the kind of the world we're in now. It's all kind of an automated process, and no having to manually print it out, sign it, and then send it back. All right, I think David, I think we're ready for the next one. So, have you sold a loan to a new investor in 2023? And I think this is just kind of something that like I said, we're trying to continue to push investors to offer more flexibility in their AOT programs, and we're finding that more of our lenders are wanting that flexibility and are taking the time to get approved with more investors that are offering this, and that are able to kind of help the clients become more efficient with their hedging strategy. So kind of not really a surprise there with the other results that we've been seeing. So what we're trying to do is add efficiency to the overall process. So one of those things, by adding efficiency, we're working with certain investors on allowing some additional flexibility to take down what we're calling a security spread commitment. So essentially what that is that's the ability to take down a commitment with a non-approved investor. The way that we do that is that we're striking, you have a security price, base security price based off of current market, and then the all-in price from the investor. There's going to be a spread to that underlying security price. So let's just call it a 1 point difference between the security strike and the price that the investor is willing to offer. So if you were able to take down, if you wanted to take down a commitment with an investor that you're not approved with, this is how we essentially allow that to happen in our system, is that you're able to market with that investor, and then that spread will be locked in at that point in time. So that 1 point spread is going to be locked in. You'll still hedge that loan during the approval process with the investor, and then once you finally get approved with the investor, call it 3 days, 5 days, a week down the road, then they'll restrike it based off the current TBA price with that 1 point spread on top of it, and then that will be the price that they'll buy the loan from you guys at. So added efficiencies in terms of kind of opening up access to more investors, and the flexibility of being able to make that commitment with that non-approved investor. We're also helping expedite that approval process with that as well. So we want to make sure that we're offering the flexibility to get approved with more investors, and to achieve that maximum pickup on all the production that you guys are bringing through the open pipeline. So I think if we're going on to the next slide, I think we're looking at the different, I said this earlier, there's different buckets where you could find efficiencies in this market. And one of the things that we've been providing to our clients has been this kind of look at, hey, here's where you could improve your execution based off of where we're seeing things, based off of where we're seeing everything execute. So definitely it looks like on the lower FICO buckets, a lot of our clients are seeing improved execution, or on some of the lower loan balance USDAs, you're able to get an additional pickup. So this is just, like I said, more ways to provide help to get you guys increased profitability, which helps helps your loan originators, which helps your borrowers. So at the end of the day, it's all about trying to find and maximize that execution. And this is where, I think anecdotally we've heard there's more credit unions that are starting to open up. I think historically they've been known to go primarily to agencies on a retained execution, but we have heard that there is kind of more opening to sell on a release basis, as Phil was talking about earlier. And by opening up that availability and opening it up to more investors, I think that you will find some added execution benefits come along with that as well. But if you were going to stick primarily to the agencies, there is a way to sell to the agencies on a released basis, which I think the next slide goes into. Phil, did you want to cover the co-issue side of it?
Yeah, no, thank you, Andrew. That was great, and actually, as with all of our webinars, Andrew, we always think we're going to have plenty of time left over, and we've got to keep trucking along here to get done by the hour. But definitely, if you guys have, so it looks like we might not have time for a long Q&A session, but if you guys do have questions, definitely reach out to us afterwards. But look, this is the current, if you look at this graph here, excuse me, the average kind of, we say average counterparties by type here. This is really our average execution outlets. It would be probably the best way to describe it by type. So you got aggregator, co-issue, and retained. Retained's kind of a funny one because there's one execution outlet for retained, right? But then if you look at those two, like the two bars between aggregator and co-issue, and this is probably obvious to most of you now. I know most of you on the line don't have this many aggregators, right? Over 20 aggregators that you sell to, but you But the majority of you that sell released, probably, if you're like the rest of our clients, and again, this is credit unions, depositories in general, you will see that there are more aggregator executions than co-issue executions when we're talking about, you know, when you're looking at selling your servicing or releasing your servicing. And you know, that's normal because that's historically, and that comes from the buy side, not the sell side. The buyers, they have wanted to buy from a small amount of counterparties a large amount of business, right? But as the industry has gotten more and more efficient from an execution standpoint, that's beginning to change. And if you just think about it, again, we're pure secondary marketing, pure capital markets. We're not operations, but we do know enough about operations to know that from an operational perspective, that graph is kind of stupid, right? That you know, that you would have, you know, 15 aggregator executions and only a couple co-issues. You know, just operationally, it would be a lot easier. Look, you still got issues if you don't like the servicer, but you have that issue on the aggregator whole loan side as well. And so our point is that what we really are working on, and we're working with the buyers. And by the way, these are a lot of these buyers, like to throw out a name, Mr. Cooper, will buy both whole loan and co-issue. So they're kind of realizing that that's the future of is being able to buying servicing, is being able to have both sides of it. And I think that, but again, when you look at you know, there's we see a lot of opportunity to grow that basically that kind of co-issue marketplace. So both Freddie and Fannie have their own programs. Freddie has the cash release exchange program, and then a different flow program called what they refer to as CIX. Fannie has SMP, Servicing Marketplace, and that's been very successful. And you know, again, the you know, if you look at the fact that our you know, lenders in general have on average 2.5 co-issue buyers, yet, you know, to use the Fannie co-issue platform Servicing Marketplace, I believe that's up, you know, well over a dozen buyers that are on that platform. And so with BAMCO, we have basically the ability to show you these live co-issue executions that you're not approved with in your best ex, and you can see what the pickup would have been had you have had that execution and reach out to that buyer and get that approval. But really, we seek to change this, you know, to change this graph and make, you know, the co-issue more like the aggregator sides. You know, and I think if we want to go, Dave, to the next slide, look, there's, you know, Andrew talked about, you know, a lot about the you know, the benefits of moving to hedging. There's a lot of efficiencies there that you have, especially in a higher volume environment. That obviously the unit workload of best effort lock versus, you know, locking multiple you know, locking volume through bid tapes. There's a lot less, you know, and a lot of automation you can use, and we've got a lot of, for those of you out there that are, you know, that are currently hedging, we definitely have a lot of automation that you can leverage. I think on the for those of you using forwards or already executing to the agency cash windows, either best efforts or mandatory, we have a functionality called Rapid Commit, Fannie and Freddie Rapid Commit, where you can execute your commitments, both retained or released, through the Rapid Commit, using that Rapid Commit functionality. And it's a lot, you know, very, very smooth, and integrates the commitment data back to your LOS. And so definitely significant time savings there. And so you can definitely, we have testimonials on that. Dave, just as we're getting to the end here, if we can go to the next slide, we have a calculator online. Our marketing team, Dave and Ian, have done a great job of creating this. And like Andrew said, I believe we're going to send out this slide deck to the entire audience, and you can click those. You can click these links here to contact us or with any questions, or to try that calculator. And I wanted to leave a couple minutes for questions. Looks like we're at 56 here, so this is a perfect time to stop. It doesn't actually, as I look at the question panel here, it doesn't look like we do have any questions. Andrew, do you have anything else you wanna add?
No, sorry for taking up so much time. I feel it's a lot of information to kind of go through in an hour. So appreciate everybody taking the time and spending it with us.
Yeah, no, look, I appreciate everybody's time, and we'll continue to do more of these webinars and with ACUMA, and yeah, thank you to Peter and ACUMA for the opportunity, and thanks for the time, guys, and hope you got some valuable information out of it. Thanks, guys.
Take care.